Joining us now on the phone is Elga Bartsch, BlackRock Investment Institute head of macro research. Elga, thank you for joining us on your outlook. What led you to this call?
So there are two main factors that caused us to shift our view. One is a very persistent protectionist push led by the U.S., and that increases the downside risk to global growth, but also creates a wider range of potential outcomes for the future. And that is, for us, the key reason to reduce some of the risk and raise some cash. But equally, we have central banks making a dovish tilt. You mentioned Powell, and they are stretching the cycle out for us. So recession risks are less of a worry, and instead we're looking at compressed bond yields and an extended expansion, and that means we are looking for fixed income products with higher coupons, such as emerging market debt or some credit exposure.
How much cash do you want to be in?
Well, we would raise it marginally to basically offset some, but the key ballast against equity or risk asset drawdowns would still come from government bonds. They are low yielding, and in the U.S. could potentially still be sensitive to excessive expectations as far as the Fed rate cut cycle is concerned. So we think that Fed expectations have run ahead of reality. But on the longer term, it's also important to have a key allocation to government bonds, because they are what helps you to offset periods of risk asset drawdowns.
And what do you wind up doing with the expectation that central banks will be dovish, will have looser financial conditions? How do you structure a portfolio with that risk?
Yeah, so there are a number of things that this requires. First of all, recession risk, as I said, is lower. So that means you can still have decent allocations to risk assets. That would include U.S. equities for us. It would also include some credits, because you don't need to worry about a default cycle moving against you. But as yields are compressed and coupons are compressed, I think you need to watch quite carefully for the relative market expectations as far as policy action is concerned. And in the U.S., we think these expectations are excessive. In Europe, we think the ECB will be able to deliver on what's priced in, and that for us has been a reason to actually not only upgrade a whole range of European assets, but also go overweight European sovereign debt.